We think an Asian portfolio has to be geared, first of all, towards the ongoing recovery in global growth in 2015, and that will be led primarily by the developed markets and principally by the U.S. economic recovery. And that means that investors do want to stay exposed to cyclical stocks and with a preference for the export sectors, in particular around Asia. But the cross-currents come from the fact that as the U.S. economic recovery continues to pick up momentum, it's going to bring with it the eventual tightening of U.S. monetary policy, Fed hikes, and it's also bringing a rather curious decline in commodity prices, given that U.S. dollar strength is also flowing from the stronger U.S. economy. So Asian investors need to be both mindful of the cyclical opportunities, but also try to steer clear of the challenges of rising rates, the stronger dollar, and lower commodity prices. We think the Chinese slowdown is something that investors ultimately should welcome, provided that it's not a disorderly or a hard rollover, sort of a downturn in Chinese growth. If China, as we expect, simply moderates to about 7% or slightly lower in 2015, that could actually bring with it a more sustainable and ultimately more rational pattern of Chinese economic activity that would remove risks from the regional economy. It does, however, mean that China, as a driver of global commodity prices and as a contributor to the strength in global energy prices in recent years, is going to be less of a factor. And so China's slowdown is also creating the environment in which oil and commodity producers are going to be coming under more pressure. But we should keep in mind that what may be negative for oil producers or metals and mining intensive economies such as Australia or Indonesia can be just as positive for the other commodity and energy consuming economies in Asia, such as, say, Korea, or for that matter, India.